Okay, welcome back. In this video, what I want to do is let's take our example that we had of these sneakers that we're selling and show it in a comparative statement, FIFO and LIFO, and the pros and cons, how it impacts the balance sheet and the income statement. So we can call this, let's call this FIFO and LIFO, pros and cons. Somebody said, well, what's the best method of inventory? Is it FIFO? Is it LIFO? Is it weighted average? Is it specific identification? The answer is you can't really answer that question. It depends on the nature of the environment that you're purchasing and selling in. Is it an inflationary period? Is it not? What we have to do is understand the implications of the method that we're using. So let's go back to the balance sheet and the income statement that we used from the prior example. And I'm going to present it a little differently. Let's put our sneakers first, just so we have a picture of our inventory and how it's moving. We had one pair of sneakers that we started the year with right here, and that cost us $10. We made another purchase that cost us $10. We made a third purchase that cost us $20. Made our fourth purchase that cost us $30. Made our fifth purchase that cost us $30, and we had our 5 pairs of sneakers. In the last video, we showed how FIFO and LIFO impacted how these things flowed into our cost of sales and sales. So let's present that like this. Let's put FIFO here. Let's put LIFO here. And use the same figures and statements we used from the prior video. We had sales was 3 units at $100. Gave us $300 here and $300 there. Our cost of sales, cost of goods sold, was 3 units at, and depending on which method of inventory we're using under FIFO, our cost of goods sold was the first 3 units down here. Let's check them. It was that one, and that one. So $20, $30, $40 was our cost of goods sold under FIFO. Under LIFO, our cost of goods sold was what? It was that one, and that one went to cost of goods sold. Those are inventory. So we have 30, 30, 20, which was $80. Giving us our gross profit of $260. Gross profit 300 minus 80, $220. There's our income statement. Let's put P&L here. Our balance sheet. What's the impact on our balance sheet? The impact on our balance sheet was when we looked at our inventory. And we said, what's the number that's going to show up on our balance sheet under inventory? Under the FIFO method, the first ones were sold, so the last ones are left. So it would have been this one for 30 and that one for 30. We have 2 units left. Our inventory, let's write, it's going to be 2 units. 2 pairs of sneakers. Which 2? Those 2. So our inventory that shows on our balance sheet is going to be $60 worth of inventory. Under LIFO, same thing. We have 2 units, but it's a different cost because the last one's in or the first one's out. So the first items that we had available go to inventory. So 10 plus 10 is 20. So we have $20 down here is the value of the inventory using a LIFO inventory valuation method. $60 is the value of the inventory using a FIFO inventory valuation. And so we find out that these numbers are not the same. Our cost of goods sold is different depending upon what inventory method we use. And if our cost of goods sold is different based upon the inventory method which we use, our ending inventory is also going to be different based upon the method of inventory that we use. And in this case, it's, if I can follow that, it's $40 difference, right? $40 difference? $40 difference. Under FIFO, our cost of goods sold is lower because we're using the older costs first. Our cost of goods sold is lower, but our ending inventory is higher. It's a seesaw. Under LIFO, our cost of goods sold is higher because it's the later purchases that we made. Our cost of goods sold is higher, but our ending inventory is lower. It's a seesaw. It's kind of like Shakespeare, to be or not to be. You have one, if you have one, you can't have the other. Here, cost of goods sold is lower, ending inventory is higher. Here, cost of goods sold is higher, ending inventory is lower. So, what's up with all this, and what are some of the pros and cons? Pros and cons. Well, for those who argue FIFO, we want to use a FIFO method of inventory. The pro is that the ending inventory figure down here will be more representative. That will be a truer figure that shows up on the balance sheet, and the balance sheet will show an inventory figure which is truer to replacement costs of those inventories. So that's the pro of using a FIFO method. The con of using a FIFO method is that your cost of goods sold is lower, your gross profit is going to be higher, and therefore you're going to have to pay higher taxes, right? Because look at this gross profit figure, 260 versus 220. So we end up paying more taxes over here under a FIFO method of inventory because our older costs are associated with cost of goods sold, and so the con is that we end up paying high taxes. Those who advocate using a LIFO method of inventory say, you know what, we're not so concerned about the balance sheet, we're more concerned about the income statement. And we want to make sure that that number right there, the cost of what we're selling, that is a truer figure, that is a more accurate representation of replacement costs according to the sales that we're making. We're making current day sales, and we want to associate current day costs with those sales. And so we realize that our ending inventory figure is lower on our balance sheet, but you know what? We're going to use LIFO because the income statement is, or the impact on the income statement is more important for us than a accurate figure being shown on the balance sheet. So the pro of LIFO is that when it comes to the income statement, we have a current matching of replacement costs with current sales figures, and the con is our balance sheet figure down here is going to be reported at costs which are historical costs as opposed to current costs, and we're just say that's the deal. That's the way it works. You can't have one without the other. You could also argue that another pro for LIFO is that you have less of a tax burden. We have less of a tax burden when we use LIFO because our cost of goods sold is higher, so we have to pay less taxes that way. Now, it turns out that most companies use FIFO. Most companies use FIFO because they're more concerned with the ending inventory in the balance sheet being a true figure based on replacement costs. And they also like the idea that our gross profit is reported at a higher number, and yes, we have to pay higher taxes on that, but what would you rather have, $260 that you pay taxes on or $220 that you pay taxes on? So they kind of grin and bear it. They say, you know what? We're going to use FIFO. We're going to have the gross profit at 260 as opposed to 220. We will pay the higher tax burden on that, and we will, for inventory, we'll show a truer figure on the balance sheet. So that's, again, that's introducing these concepts. In an intermediate level class, you get into this in more details. You'd see that you could report one way for books and one way for tax purposes, but for purposes of just introducing these concepts, those are some of the pros and cons for using each method. Again, it's not that one's best. There's no such thing as a best method. It's more an understanding of, given the methods are available, what are the pros and cons for each. So I hope this has been helpful. If nothing else, I hope it stirs up questions. And the good news is you can bring those questions to class, and we can dig into them deeper until the light bulb comes on. So thanks for being part of this.